When we think of investing, safety is often at the top of our list. Many people believe that sticking to safe investments like bonds or cash will protect their money. But here's a shocking fact. Since 2000, the average bond fund has delivered just 2.4% annual returns. Meanwhile, inflation has risen about 2% each year. That means you're barely keeping up with rising prices. Here's another eye-opener. Nearly 60% of Americans have no idea that inflation can erode their savings. Many think that keeping money in the bank is a foolproof way to secure their future. Unfortunately, the truth is that cash can lose its value faster than you might think. With interest rates at historic lows, safe investments can become risky traps. So, why do so many people fall for the illusion of safety? In this video, we'll explore the hidden dangers behind traditional, safe assets and reveal why they may not be as secure as they appear. We'll dive into strategies to identify true value, uncover the risks of over-diversification, and challenge the common advice given by financial experts. Are you ready to rethink what it means to invest safely? Join us as we uncover the truth behind safe investments and discover smarter ways to grow your wealth. Chapter 1. The Mirage of Security. Unmasking safe investments. When it comes to investing, the label safe is incredibly appealing. Many see it as a way to secure their money, imagining that safe assets are free from the headaches of volatility. But this view can be misleading. As Warren Buffett says, risk comes from not knowing what you're doing. And in the case of safe assets, people often overlook the real risks. For instance, U.S. Treasury bonds are seen as one of the safest investments globally. In fact, more than $12 trillion is invested in U.S. government debt because of its low-risk reputation. But what happens when interest rates rise? Bond values fall. Between 2021 and 2022, bond investors faced some of the steepest losses in recent history. Bonds meant to be safe dropped by as much as 10%, 20%. Another example, blue-chip stocks, which are popular in portfolios for their stability. Think of companies like Coca-Cola or Johnson & Johnson. While they're generally less volatile, that doesn't make them free from risk. In fact, Coca-Cola lost nearly 40% of its value during the 2008 recession. This safe stock didn't seem so stable after all. One strategy to avoid falling for the mirage is understanding true intrinsic value. When a stock's price aligns with its intrinsic value, you know it's less likely to swing wildly. Instead of chasing safe labels, focus on understanding what makes an investment fundamentally sound. Look beyond the hype and instead ask, what's the real risk here? This approach, while not as exciting as riding stock highs, is a key principle of successful value investing. Chapter 2. False comfort. How stability can hurt your portfolio. People often invest in stable assets because they think they're protecting themselves from major losses. But there's a hidden cost here: opportunity. Benjamin Graham, the father of value investing, called these stagnant assets. These investments, while stable, can hold you back from achieving the returns you'd get with smarter, risk-adjusted investments. Let's look at a case in point: certificates of deposit, CDs. CDs are incredibly popular among cautious investors because they offer guaranteed returns. Yet, these returns are often so low that they don't even keep up with inflation. In 2022, the average inflation rate was 8%, while most CDs offered returns below 2%. This means that, in real terms, investors lost money by sticking with safe CDs. Another example is utility stocks. These stocks are known for stability and often pay steady dividends. But while they seem like a great option for low risk, they often come with low growth. A study by Morningstar showed that utility stocks have delivered lower long-term returns compared to growth sectors like technology or healthcare. If you're overly reliant on these stable sectors, your portfolio may fall short over the years. So, what's the solution? Consider a balance of stability and growth. Instead of putting all your money into low-growth assets, diversify a portion into undervalued stocks with potential for appreciation. Look for companies that are fundamentally strong, even if they aren't seen as safe. The result? Your portfolio can still benefit from stability without sacrificing growth. Chapter 3. Inflation's silent attack. Why low risk doesn't mean safe. Inflation is one of the sneakiest risks for any investor, and it's a major problem for safe assets. When inflation rises, the buying power of your money goes down. Assets like bonds, cash savings, and CDs lose value faster than you'd expect. As Warren Buffett warns, the arithmetic makes it plain that inflation is a far more devastating tax than anything that has been enacted by our legislature. Imagine you have $10,000 in a savings account with a 1% interest rate. Over 1 year, you'd make just $100 in interest. Now imagine inflation is running at 5%. That means, in real terms, you're losing $400 every year. For investors who rely heavily on safe assets, this loss is especially painful because it adds up over time. One strategy to counter this is investing in assets with pricing power. Pricing power is a company's ability to raise prices without losing customers. Think about companies like Apple or Coca-Cola. They can increase prices because their brands are strong, and people continue to buy their products. Investing in companies with pricing power helps your portfolio keep pace with inflation, unlike cash or bonds, which have no way of adjusting. Gold and real estate are other options often used to hedge against inflation. Gold has been considered a hedge for decades, though its value fluctuates. Real estate, on the other hand, has historically kept pace with inflation. From 1970 to 2020, U.S. home prices have increased at an average rate close to inflation. While these assets may not provide high returns, they tend to retain value when the cost of living rises. In today's world, inflation is a constant concern. Protecting yourself from inflation requires a shift in thinking. Instead of relying on safe assets, consider a mix of assets that can grow with inflation. By balancing between value stocks, real estate, and even commodities, you can maintain the value of your investments in the long term. If you're finding this information valuable, be sure to subscribe for more insights into smart investing strategies. Chapter 4. The overlooked risks of over-diversification. Diversification is one of the first rules of investing. We're told not to put all our eggs in one basket. But too much diversification can actually hurt your portfolio, a concept called diversification. As Peter Lynch famously said, owning stocks is like having children. Don't have more than you can handle. The idea behind diversification is simple. Spread risk by investing in multiple assets so that if one goes down, others balance it out. But there's a limit. When you hold too many different assets, your portfolio can become overly complex and harder to manage. Studies from Vanguard show that owning more than 30 stocks gives almost the same risk reduction as holding 500 stocks. Consider someone who owns dozens of safe assets across sectors. On paper, this may look diversified. But if the majority are low growth, low return assets, the portfolio is essentially stagnating. With too many stable assets, you might end up spreading risks so thinly that you actually dilute returns. You're protecting yourself from volatility, but sacrificing any real growth potential. So, how do you diversify without going overboard? Stick with quality over quantity. Choose assets with strong fundamentals and avoid the temptation to buy everything that looks stable. Instead of 50 stocks, try holding 10-20 that you deeply understand and believe in. This strategy keeps your portfolio manageable and focused, while still providing balance. Chapter 5. Trust issues. The hidden costs of expert-approved investments. Following expert advice feels safe. After all, they know what they're talking about, right? But blindly trusting expert-approved investments can lead to some costly mistakes. Take financial advisors, for example. They often recommend bonds or index funds for safe returns, but they may have an incentive to do so: fees. According to a study by Morningstar, fees on actively managed funds can reduce returns by up to 1.5% annually. Over decades, that small percentage eats away at your returns. And some advisors recommend investments based on partnerships or bonuses, which may not align with what's best for you. As Charlie Munger famously said, "Show me the incentive, and I will show you the outcome." A classic example is the safe recommendation of 60% stocks and 40% bonds for retirement. While this portfolio mix has historically performed well, it's not the only option, and it may not be the best for everyone. In recent years, bond returns have been low, and inflation further weakens their purchasing power. Yet, many advisors still recommend this mix because it's widely accepted as safe. To avoid these pitfalls, learn to question everything. Ask advisors why they recommend a certain asset, and always consider the costs. Explore alternatives like dividend-paying stocks, which provide regular income and the potential for growth. By questioning expert advice and understanding each investment's true cost, you can make smarter, value-based decisions that align with your personal goals. If you enjoyed this deep dive into the risks of safe investments, don't forget to subscribe for more insights and strategies to help you invest wisely.